Brenda and Natalie, thank you. Thank you for the wonderful introduction. And I love that Brenda thinks I'm younger than I actually am. So I did actually have a career before my finance career. I have been in the financial industry for 25 years now. I do want to let you guys know that I have children the same age as you guys. They are in university, so the conversations that I have with them every day is much like the conversation that I'm going to have with you guys today. Again, when it comes to questions, absolutely interrupt me. I have slides, but if we get off topic and that's more of what you need to know, wonderful. I don't want to sit here and just yammer away and you guys think, well, that was useless. I want this to be for you. It is for you, and it's your opportunity to learn what you need to know. I am definitely open after the session as well. I'll provide you with my email address, and you can certainly email me any questions if you weren't comfortable asking them in the group setting. But this is what we're here for. Financial literacy is part of your overall health and wellness, because most people stress about their money. Arguments in relationships, a lot of them happen over money. So this is something that, knowledge is power. And the more that you're able to understand and take charge of for yourself, the more independent you can be financially, the better off you will be all around. So welcome and thank you. We have a huge group here, and that is fantastic. This is probably the largest group I have presented to, and I'm really excited about that. I am going to share my screen so that we can have our slides up. I'm hoping I can get the right slides here. Okay, can everybody see the slides? I'm not getting any responses. Caleb, you got it? Okay, Natalie, thank you so much. So we're going to be speaking about, as you know, it's the #adulting program. In module 1, we're going to be speaking about debt. So what we're going to learn here today, oh, sorry, the videos don't work, so we're going to bypass that. So what we're going to learn today is we are going to learn what debt is, the role of lenders and creditors, what interest is, and the different types of interest that you can be charged. Advantages and disadvantages of credit, because there is good credit or debt as well as bad credit or debt. And we'll talk a little bit about that difference. The types of debt, so the different types of credit that you can obtain and your repayment options, and different types of loans and how amortization works. So that's a lot to cover, but we have 2 hours. I do want to make sure that everybody knows I'm going to be watching the time. So at about 10 o'clock, we'll take a short break as well. Okay, there's no way I can talk for 2 hours. Actually, I can talk for 2 hours straight, but it's not going to be good. So what is debt? And I want feedback, guys. I will stay silent until somebody pipes up. So what is debt? And please don't read the slide. Anyone? So we have a really quiet group today. Okay, everybody's being a little shy. Well, debt is anytime that
stuff in chat with the answers. So I think they're a little shy. It says outstanding credit, money assets you can't pay back, money you have to pay back, owing, money you borrow that has to be paid back, or when you owe money. So there's a whole bunch, but they're all in chat.
Awesome. Okay, and like Brenda mentioned before, I'm not able to view chat when I'm in the slides. So thank you very much, Brenda. So yeah, absolutely. Anytime you borrow money and there's an expectation of repayment, that is debt. So it doesn't matter where that comes from. If you borrow $20 from your friend, they said, I'm going to need you to pay that back. That's debt. It can be as simple as that. If you get a credit card and use it, charge something to it, that's debt. If you get a car loan, that's debt. So why do we, and I guess I want to say as well, debt and credit are often interchangeable terms, but they don't necessarily mean the exact same thing. So we'll talk about that a little bit more. in the next, I believe the next slide. So with debt and credit, what are some of the types of debt/credit that you can get? Or what are some of the debt that you guys actually have?
Student loans would be a big one. For
Student
us.
loans?
Mortgage.
Yeah, absolutely. Mortgages, lots of people have those. How many of you have credit cards?
Yes.
Lots, I bet. Okay. We seem to be in a society that we don't really feel that we can do much without credit cards. So this is where I'm going to talk a little bit about credit as well. We say credit cards, but when you use it, it's actually a debt. So even though people use credit and debt interchangeably, debt is more of a negative term because it's something you owe. Credit can be a little bit different. And can anybody explain to me how, I guess, what credit means to them?
Like gaining a reputation through your bank.
Absolutely, that's a good description. Very good, thank you. Does anybody else have something that credit means to them?
It can be good or bad.
Absolutely.
Hi, good morning. It's Michelle here. Debt to me, like you said, it to me, it is a negative term. It's like money that you may or may not be able to pay back. Credit to me is like a type of measurement to prove whether you are in good standing or bad standing, and usually it referred to, well, I think it's positive anyway, to just show the ability to pay it back or not.
Absolutely, you guys are all correct in what you're saying there. And I'm just wondering how many of you have noticed, or I'm sure you'll notice it after this, when the term debt is used and when the term credit is used. So for example, we don't call them debt cards, we call them credit cards. So, but when you use it, it's a debt. So sometimes marketing, and I shouldn't say marketing, but the way things are presented and have always been presented, they try to put a positive spin on it, and we'll use a word that's very similar or a term that's interchangeable to put a positive spin on it. And a lot of people will say, oh, I've got great credit. Well, you could have great credit, but how much of that is actually debt? So say somebody has 3 credit cards, a car loan, and a student loan, and they're paying it back as agreed. Well, that's great credit. It means they have great credit. It means that they've established great credit. However, if they are maxed out on all of those credit cards or line of credit or whatever else, that can actually be seen as bad debt. So you do need to be careful and really listen as to how those terms are being used sometimes. Does anybody have any examples of how perhaps you've heard credit being used when really it should have been debt as the correct term?
When you're like buying something on credit, so you don't have to pay for it for X amount of time.
Exactly.
I love it.
Exactly. So you're buying something on credit, but you're actually incurring debt. So that's a fantastic example, Emily. Thank you so much. Does anybody have any questions about the difference between those terms at this point?
Just a couple of little comments that are good in the chat. Mary said, I wish they called them debt cards.
Yes.
And then Laura said to the last question, lines of credit would be another type of debt.
Absolutely, yes. You guys have it going on. You guys know what you're talking about. So, when you incur debt, you're incurring debt from a lender or creditor. And again, here's another time that creditor is being used when maybe it should be a debtor. So a lender or a creditor is a person or organization that lends money. Can you guys give me some examples of a lender or creditor?
Lots of banks are coming up in the
Would
chat,
the
as well as car dealerships.
would the university count? Because they're taking our money and expecting us to pay them?
Well, no, that's more of a bill payment because you don't borrow anything from them. You're paying up front for the service that you're getting, which is your education.
Okay, thank you.
You're welcome. But that's a great question. That's very different from, say, for example, buy now, pay later. You may not have to pay anything for 6 months, but you still have that debt hanging over your head. And a lot of people will call that credit. So we have, the banks, of course, different credit card companies, especially like Capital One, MBNA. They're not necessarily attached to a bank, but they are creditors. And I'm putting creditors because I still think that the term should be debtor. But if you're purchasing a car through the dealership and they do their own financing, so for example, Honda Finance or Toyota Finance, that's the credit department of those companies. I'm trying to think of what else. There's really all kinds of examples out there, but even like I mentioned earlier, even if you borrow money from a friend or your parents, for example, and there's the expectation that you are going to pay that back, then that person is a lender or a creditor. What kind of conditions might apply to the repayment of any of your debt?
There's just a question in chat as well. Are loans different from credits borrowed?
Not really. Not really. So a loan is a type of credit borrowed. And again, that's where the term credit or the term debt is being used interchangeably and really shouldn't be. So I think we mentioned it earlier, the types of debt that we can incur would be the credit that you're borrowing against. It's the exact same thing. So loans, credit cards, lines of credit, mortgages, all of those fall under credit that you can borrow against, which is the positive term, or debt, which is the more negative term. Okay. Any other questions around that? No? Okay. So again, back to conditions that may apply on your repayment. What sort of conditions, like I think that you guys have some experience with student loans and credit cards. What kind of conditions do you have on your repayment of those debts?
Would a condition include like a grace period? Like when you pay back your student loan, you have that 6-month grace period?
Absolutely. Yeah. Any of your terms and conditions that are on your contract, all that fine print, all that legal speak, that's where your conditions of your repayment are going to be. And you may not be interested in reading all of those conditions. However, you should at least browse it. And anybody who is lending you money should go over the terms and conditions with you. So for example, a bank will tell you exactly, they will go through the loan document before you sign that to make sure that all of the terms and conditions are agreed to. And you normally have to sign an initial here and some other stuff. If somebody is not going through the terms and conditions with you, demand that they do. Because reading that stuff, you may, It's the same thing if somebody, well, if I were to go even to my own bank, CUA, and get a particular type of mortgage, for example, I've had mortgages, I have a mortgage, but this one might be a little bit different. So the terms and conditions around it may differ slightly. And if I don't read anything, if they don't tell me, how am I going to know? And even if I'm going to read it, like I said, it's legal speak. I'm not a lawyer. So have it explained to you. Demand that it's explained to you. Okay.
Lots of stuff in chat too about different types of conditions like due dates and recurring payments and interest and time limits and liens and different interest rates changing due to inflation or vice versa. So there's a lot of different things coming in chat.
Perfect. You guys know what you're doing. That's awesome. Now I did hear a word there, and I'm wondering if anybody knows, can explain it to me. There was the word lien. So when would a lien become a condition of your debt? Or does anybody have a definition of what a lien is?
Sorry, good morning, it's Michelle. I was the one who put that in. Not that I've ever had to experience it, thank God. But the way I understand it is if you cannot repay your debt, they can kind of take it back or put a condition so that you cannot use that, whatever that product, until you can pay it.
Exactly. So the other term for lien is security. So for example, when you purchase a new vehicle, usually you have what they'll call a secured loan for the vehicle purchase. What that means is if you don't make your payments as per the terms and conditions, that they can come and take that car back. Okay, it doesn't mean that that wipes out your debt or your loan for that car, but they can come take the car back. It's the exact same thing as a mortgage. You have your mortgage, the lien is against the property that you got the mortgage for. So there are different types of liens, but we'll talk about that in a little bit as well. So if you hear the word security or lien, just realize that whatever debt you're getting to make the purchase, the thing you're purchasing can be taken away if you don't abide by the conditions.
And just another question in chat, Kira was wondering, what is a recurring payment? Because that was mentioned up above.
Okay, a recurring payment is going to be a payment that's required on a certain timeline. So whether it's bi-weekly, weekly, monthly, you know, whatever. More so, we talk about them with loans or mortgages, simply because with a line of credit or a credit card, if you don't owe anything that month, a payment isn't required. So it's not necessarily considered a recurring payment. The recurring payment is going to be on a set schedule, and you're going to usually have a set payment. Any other questions about this particular slide or what we've talked to up to this point? Okay, fantastic. So let's talk a little bit about interest. Who can give me a definition of interest or tell me what interest is? I see somebody has their hand raised. You can just go ahead and speak up if you unmute yourself.
Hi. So interest would be like set probably monthly, and it's a certain percentage that accumulates, which with every like late fee, basically.
Yes, yeah, they're a little bit different from late. You're right in kind of liking it to a late fee. You're absolutely right. However, there are actual late fees and interest. So I don't want anybody to get confused. So, you know, how many of you said you have credit cards, how many of you have not paid your balance in full by your due date on your credit card? You know, let's get you guys to raise hands here. If you don't mind, you don't have to divulge anything, but. Okay, so I'm seeing a few there. Okay, so let me tell you, interest is what is charged on the debt that you owe for a couple of different reasons. So for example, in very simple terms, the way a bank works is we take your money in whether it's investments or savings accounts, and we use that money, not physically, but we use that money to then lend out to other people. So the interest is what we charge the people that we're lending the money to make money, basically. Okay, so it's basically the fee for you using our money. Does that make sense? It's usually based on an annual interest rate, and there are different ways that interest can be applied. So I asked the question about the credit cards and not paying your balance in full by the due date because the way interest is applied on a credit card usually surprises a lot of people. And I will tell you, I have never given out a credit card to a client without explaining this. And I have had 60 and 70-year-old clients who do not know this, okay? When you make a purchase on your credit card, say you purchase something for $50 today, tomorrow your statement is printed. You then have what is called a grace period. And I think, Emily, I think it was you that mentioned a grace period around student loans. Well, with a credit card, the day your statement is printed, you normally have a grace period of 21 days before your due date. So if you miss that due date, or if you don't pay that full $50 that was your balance owing by that due date, then your interest gets backdated to the date of the purchase. What a lot of people believe is that if you miss your due date or if you don't pay that balance in full, your interest only starts once that due date passes, and that is not correct. Okay, so just to let that sink in, because credit cards, people do get themselves into a bit of trouble with credit cards at times, and this is one of the reasons why. The minimum payment that they require on a credit card is usually $10. Maybe a little bit more if your balance is much higher, but usually it's $10. So people think, oh, okay, great, I'll pay my $10, payment's done, fine. Well, then your interest, which is usually about 20%, gets backdated to the day you made your purchases and charged until you pay that purchase off in full. So you can end up paying almost double the purchase price by the time you finish paying that off if all you're doing is paying your minimum payment. Keep in mind as well, if all you're paying is your minimum payment, the $10, chances are you're not even paying the interest in full. And that just keeps building and building and building. And a lot of people don't, they have a problem being able to get out of that because they're not making big enough payments. And, you know, their balance just keeps going up. Does that make sense around credit cards? Does anybody have questions about that?
We've got one question in the chat from Carrie Lynn. Is that the same interest for a line of credit?
No, with a line of credit, you're charged interest when you use the money. So the day that you take the money, interest begins to be charged. Now, if you take a cash advance from a credit card, interest is charged immediately as well. There's usually a fee on top of that. So say you're going out for the evening and you really don't have the money to go out, but you're like, oh, I can take $100 off my credit card. Well, your interest rate is usually a little bit higher than the 20% on a cash advance. So you're going to be paying that extra on the interest right away. There's usually a fee of about $4 to $5 just to take that cash advance. So right there, you're at, you know, $105, say, and if you used an automated banking machine that is not your bank's, you're also paying the $3 fee on top of that. So your $100 night out, as soon as you take that $100, is costing you $108. And then you consider the interest, and if you have any trouble paying that off over time, it could cost you quite a bit. I hope that explains it. You know, so there are certainly the lines of credit, which usually have a better interest rate, most often have a better interest rate than credit cards, but be aware that certain things that you do with your credit card is not to your benefit at all, not at all. Okay. Any questions about cash advances on credit cards?
There's a little bit in chat as well. Somebody had a question. If you haven't paid back your credit card before it expires, what happens? And then somebody answered it with, they automatically send you another credit card 1 month prior and the debt is carried over.
Yes, that's exactly correct. So thank you for answering that. That's fantastic. When you see an expiry date on your credit card, it just means that they're going to send you out a new card. Generally, credit cards, the magnetic strip, actually, I'm kind of dating myself. The magnetic strips don't have, used to have a shelf life on them, for example. That's when we used to swipe everything before we had tap or the chips. And really before we had online banking. So I'm definitely dating online shopping. I'm definitely dating myself. But it's a way to ensure that the credit cards are being used by the correct people. So the credit cards go out to your home address. Usually it's within the same month that your card expires. They used to send them out a month in advance, but people weren't looking for them. People are only looking for them when they realized, oh, my card's expiring this month. So with people not looking for their credit cards, there was a lot of mailbox theft and people would get your credit card and start using it. So, two things have changed that. Excuse me. They changed when they send them out closer to the actual expiry date. You see on your credit card a month and a year. It doesn't expire until the end of that month. The other thing is you now have to call in to activate your card. And most times you need to call in from the phone number that your bank or your credit card company has on file for you. So it's more likely that that credit card is in your hand. Okay. So do we have any other questions about just basic interest? We're going to talk a little bit more about interest, but I'm just wondering if there's any questions out there right now about interest.
I've got a couple in chat. Kelly is wondering if you could end up paying double because of interest after spending $10, does that mean you're paying $20 at the due date?
Not at the due date. So this would be if you're not able to pay your balance off in full by your due date, then interest, like I said before, gets backdated. So what happens is over time, as you're making more and more purchases with your credit card, that $10 charge that you put on, say, 6 months ago, if you did cash advances and you have interest owing, those are the things that get paid by your payments first. Your actual purchases get paid last. So there's a certain sequence that the credit card companies use when you make a payment so that certain items get paid off first. And honestly, it's in the credit card's best interest, that sequence. So that's why people, if they can't pay their balance in full, they sometimes end up getting into a situation where they find they're just spinning their wheels and they can't get that balance down at all. Does that make sense? Is that enough of an explanation for the person that asked that question? Okay, I hope it was, but if not, certainly in chat or just unmute yourself and ask away.
Few
But
more
let's go.
questions in chat as well. We got lots of great questions this morning.
Excellent.
Wondering, and I hope I'm pronouncing their name right, how do you use a credit card smartly? Should there be certain purchases that should be made with a debit card and not with a credit card?
It depends on your financial responsibility. So that is a really good question. And one thing that I want to bring up as well, your personal finances are exactly that, your personal finances. So what might work for your friend or what might even work for your sibling or your parents doesn't mean it's going to work for you. You have to consider what your needs are, what your responsibility level is. If you're a spender, you're a spender. Accept it and use cash. Because then when you're out of cash, you're out of cash. If you're quite responsible with a budget and your credit card offers cash back, for example, then it might be really good to apply your budget to your credit card. So, you know, for example, really simple, your budget is $100 this month for eating out. Well, you can use your credit card to pay your bill for eating out. You know, you're not going to go over $100. And then you just pay the $100. You've already budgeted for it. And you just pay it back to your credit card as soon as you can, or at the very least, by that due date. So if you have that kind of responsibility around your finances, then fantastic. Use your credit card, because if it's going to give you cash back, you're getting a little something out of it. Okay. But I would suggest don't use a credit card unless you know you can pay that off by the due date, or it's a real emergency. Okay, so if your car broke down, it's the middle of the night, you know, the best thing to do is to get a hotel room for the night, or to call, you know, a tow truck right away. Then use your credit card. That's a real emergency. However, you should have savings for those kinds of things as well, but sometimes your credit card is the only way to make those types of payments. You know, it is a great question, but again, it comes down to, you know, personal experience and personal responsibility. So for example, I put everything on my credit card, everything. Even if I buy a pack of gum, it goes on my credit card because I really like the point system that I have. I use the point system every year and get quite a bit back. You know, like I explained earlier, I do have children that are the same age as most of you guys. And one of them, who I thought was really good with her money and normally is, she said, "Oh, I got to stop shopping. I spent $1,000 again this month." I was like, like, where are you getting $1,000? So, you know, you have to be self-aware, and you need to really sit down and be honest with yourself about whether using a credit card is something you can manage or not. Are there any other questions there, Brenda?
Not questions specifically. We've got some students answering other people's questions,
Awesome.
which is great. It seems to be going well that way. You know, people seem to know if, you know, if you're getting interest, so you're getting interest if you don't fully pay. So the goal should be to fully pay what you bought each time, which is perfect. And then
Yes.
somebody else said they got talked into getting an Air Miles credit card instead of cash, and they regret it. So then somebody else said you can switch it back, like go to your bank and get it switched back. And then Michelle is saying she makes her 7-year-old try to manage their money too with piggy banks and projects. So great work.
Yes.
There's also 2 students with their hands up, Sam and Winta. I think they have questions. I don't know if you want to take those questions now.
Yeah, absolutely. I think that may actually be from something earlier though.
Oh, okay. All right.
Yeah. You know what, I will tell you, with my own children, you know, I did a lot of exercises, and this is the thing that a lot of people don't understand. When it comes to teaching finances to your children, it doesn't have to be sitting down and talking about your specific financial situation. There's a lot of, you know, child experts who say, don't do that, it'll stress your child out, blah, blah, blah. But some of the exercises that I did with my children, for example, you know, we'd be walking through the mall, they'd smell Cinnabon, and they'd look at me and say, "Mommy, I'm hungry." I'm like, "Great. When we have the chance, we'll go to the grocery store and get you an apple." And they'd be like, "No, I want Cinnabon." I'm like, "Well, here's your money. You can go spend it." Right? So it's just things as simple as that. You know, they need to understand if they want to treat themselves, it's going to cost them. You know, that it's as simple as that. You know, let's get back to interest a little bit. There are definitely these 4 types of interest. Does anybody know what any of these types of interest are, and can you explain them? Oh, I wish you guys would just unmute and speak up.
Hi, Laurel.
Hi, Laurel.
Hi, I think simple interest is just, if you owe $100 and the interest rate is 5%, then you pay $5 on that 100% for whatever period of time they tell you. It's this simple because I guess it's the easiest to calculate.
Yep, exactly.
And then fixed interest would be, I'll just do two. Fixed interest would be again, an interest rate that doesn't change. So regardless of what happens with inflation or how much money you're borrowing, it just stays the same all this time and is really predictable.
Those are great explanations. I will caution you around the fixed interest. There's almost always in the terms and conditions that if interest rates go above a certain amount, that fixed interest rate can change. So the banks won't tie themselves into anything specific for an unknown length of time. I shouldn't say banks, lenders. So for example, credit card interest on purchases has been 19.99% for most credit cards for eons. 25 years ago when I started my banking career, that's what the interest rate was. I think there was a short time where it went down to 17.99% and then it came back up to 19.99. Everybody assumes 19.99. However, if when we come out of the pandemic and the economy takes off and the Bank of Canada decides to increase interest rates, well, then that could change. So you could see interest rates go up to 21%. And they could stay there for decades. So technically, yes, a fixed interest rate isn't supposed to change, but in the terms and conditions, there's usually a trigger rate. So if, the prime rate changes enough, that will trigger a change in that fixed interest rate. However, if you're borrowing money for a shorter term, so say a 5-year or a loan that will take you 5 years to pay it off, that's going to be a fixed interest rate. Okay. Great examples. Can anybody explain the floating or compound interest? No, those ones are a little bit tougher. So the floating interest can also be called a variable interest rate. And that's usually based on a certain percentage above, sometimes below, but not usually, but above prime rate. So prime rate is set by the Bank of Canada, and the banks all set their own individual prime rates based on that. So the prime rate of Canada is usually a point, sometimes a little bit more than one full interest point, less than what the banks charge. And that, so as prime rate goes up or down, so will the interest rate on your variable rate loan or your variable rate mortgage. Most often you'll see a floating interest rate on a line of credit, because a line of credit interest rate is always based off of prime. It's never a fixed rate. Compound, so as you can see, fixed interest rate and floating interest rate, those are two terms that kind of go together. So you can get a loan, a mortgage, or a credit card at a fixed interest rate, or you can get a mortgage or a line of credit, sometimes loans at a floating interest rate. Sometimes credit cards, there have been products or credit card products out there where they're also based off of prime, and that would be a floating interest rate, okay? Simple and compound interest, they're terms that go together as well. So simple interest is you're charged interest based on the balance. Compound interest is sorry, let me qualify that. That was a really bad description, my apologies. So simple interest is you're charged interest on the balance you owe, not including any interest that's been charged. Compound interest is you are charged interest on the balance, including any interest that you owe. So as you can see, simple interest, they're just calculating it on that balance, not worrying about how much interest you already owe. Compound, they are taking that ending balance each and every day, including the interest, and calculating more interest on top of that. So you are actually paying interest on top of interest. So in that way, it compounds, it builds. Okay. Emily, you have your hand raised?
Yeah, I'm just wondering if you go over what the prime rate is again. I didn't quite understand.
Okay, so prime rate is set by the Bank of Canada, and prime rate does a couple things. So there's two ways that the Bank of Canada either boosts our economy or slows our economy down. And the reason that they do that is to combat inflation and some other economic factors. I'm just wondering if I can use an example here. So right now, because people are out of work because of COVID, they're not spending as much. We have supply chain issues. Our economy isn't necessarily growing that fast. So interest rates stay low. That's to encourage people to spend more. And as you spend more, that makes our economy a little more vibrant. So you go out to restaurants more, you buy those luxury products a little bit more, you don't go without as much. You are willing to spend that money because it's not going to cost you as much to borrow that money. Okay, more people are buying houses because the interest rates on mortgages are so low right now, which means they can afford a bigger house, or they can actually afford the prices that the houses are right now. If the economy is really booming, excuse me, so for example, we come out of the pandemic and everybody's got jobs, say, actually coming out of the pandemic isn't the best example. Generally, when a country goes to war, that boosts the economy. So they move a whole sector of people out of the workforce to go to war. The people who are home then have to fill in those spots. And there's also more industry being required to build, planes and whatever else they need for war. So that boosts the economy. The economy is very vibrant. Everybody's working. Everybody has more money. There's more demand on our industries for the stuff that they need to supply for the war. So interest rates will go up to keep things from getting too expensive, because the economy will be like, oh, everybody's got money. I can charge more for this product than I did, a month ago. Okay, so interest rates will go up to discourage spending. So they try to keep the economy kind of level. Okay, that can be definitely a hard thing to understand, and it's definitely hard to explain. But does anybody have questions around prime rate?
We actually have a number of questions, not necessarily around prime rate in the somebody wanted to know what kind of interest would be on student loans. Somebody thought it might be simple, but they weren't sure. So did you want to talk about what type of interest is on the student loans?
I believe it's simple interest. I believe it is. I would have to look that up, but I can definitely look that up on our break and let you know. But I'm pretty sure, because it's a loan, I'm pretty sure it's simple interest, but I will confirm that for you.
Okay, and then they're wondering, if you can explain floating and simple interest, and they're kind of wondering if you can give some context with an example for each.
Okay, actually, simple interest is, I'm not going to give you an example. I'm going to give you the actual calculation for simple interest. So the calculation is the dollar amount times the number of days that that dollar amount will be outstanding times your interest rate. So say we're talking about a credit card, so your interest rate would be 19.99%. And because that interest rate is an annual interest rate, you take that whole thing and divide it by 365. Okay, now I'm not sure, Brenda, are we able to get like a whiteboard?
That's a really good question. I was typing this in as I go, but annual, I'm pretty sure we can. I just want to do this
Now, I'm going to do it.
65.
I think I can do it right here. Yeah. So if we go number days times, oh, sorry,
Perfect.
that's wrong. It's your dollar amount times your number of days times your interest rate. Oop. I'm spelling things incorrectly. There we go. Divided by 365. That's your simple interest calculation. So for example, if you owed $50 on your credit card and you went past your due date without making a payment, so let's say your balance is going to be outstanding for 45 days. Who can give me the answer as to what interest would be charged? And say, yeah, so your balance is $50 times your 45 days times the interest rate of 19.99. And then all of that is divided by 365. Does anybody want to take a stab at that answer?
Kira's wondering why you divide by 365.
Because your interest rate is an annual interest rate. It's not a daily interest rate. So you then need to divide it by 365.
So we've got a couple, Tony says $30 and then says they feel like they're way off. And so we've got $1.23 seems to be the main answer.
Yeah, $1.23 is correct.
Would the formula change on a leap year, or would they remain the standard 365?
It stays the standard 365. You know, that's a question I've never been asked, but good question, definitely. It does stay on the 365. We don't change that for a leap year. So does that answer the question or sort of explain simple interest a little bit better? So for example, compound interest would have to be calculated for each and every day because your balance is going to change each and every day. So like I had said before, your dollar amount, you may start with $50 and then the next day it's going to be $50.02 and the next day it will be $50.04. So compound, because we're charging interest on interest with compound interest. So it's a much more involved calculation, and you need to know the daily interest rate for compound interest. And I think the question also asked about floating interest. And again, floating interest is usually floating or called variable because it is based off of prime rate. And prime rate can change at any time given what the economy is doing. Do we have any other questions around that? No? Okay. I'm going to take a quick look at the next slide here. There we go. So it's just about 10 o'clock. Why don't we take a 5-minute break and we'll come back and talk a little bit about the advantages of credit. So I'm seeing here, well, the time that I have is actually 9:59. So if we can come back at 10:05, that would be great. Thank you, guys. All right. So I have 10:05. I've been looking for the answer to the student loan question and if it's simple or compound interest. I'm not really getting a straight answer on it. They keep telling me that, federal loans use a simple interest formula. So it does seem to be, yeah, it does seem to be for government student loans. It seems to be, oh, there we are. It seems to be the simple interest. However, if you have a private student loan, which I don't believe we can do in Canada, and that's different from a student line of credit that you get from your bank, that could be compound interest, but the government student loans seem to be simple. Okay, so the next few slides, we're going to go through a little more quickly because we've had a little bit of a chance to chat on some of these things as well. So what can be some of the advantages of using credit or even having credit, considering the way we define credit to begin with?
It helps getting you loans with the government, I mean, with the banks as well. It's one of those things that if it's used wisely, that it could benefit you in the long run. Yeah.
Yes, yep, that's correct. So it can put you in a situation where having good credit in the long term can get you ready for, you know, if you're using your credit cards now responsibly and you're able to pay them off each and every month, then when you go to get a car loan or you go to purchase your first property, all of that counts towards the credit that you have and the history that the banks and lenders look at to be able to decide, you know, will we lend to this person or not? What are some other advantages of having credit or even of using debt?
A few things in chat. Having a good credit score helps you get loans and to make large purchases. And another person says, so we can be qualified for bigger purchases and maybe qualified for a better interest rate. And
Yes.
Kelly says, we want to have a good credit score.
Yes. So a couple of things there. Credit or using debt, you can help us make purchases that otherwise we would never be able to save up for. You know, who can really pay for a house with cash? Who can, you know, even these days with the prices of cars, who can buy a car with cash unless, you know, you're well established? And even if you're well established, it doesn't necessarily mean that you want to use your cash to purchase a vehicle. Again, to be able to get your education through student loans and student lines of credit. That's some advantages of having credit or using debt. And again, this comes down to, I put out the terms there, bad debt versus good debt. So things such as your education, your student loans could be considered good debt. Does anybody want to take a stab as to why or what would make it good debt? Okay, have I stumped them all, Brenda? Okay, so good debt is debt that is used, again, to your advantage. So for example, good debt would be purchasing, like getting a mortgage and purchasing a home, because your home will increase in value over time, but the mortgage will decrease in the balance. So that puts you to a better financial position overall. Your education will hopefully help you secure a better career with a better income that will, again, help you progress financially and get you the things that you want in life. So that can be considered good debt. A car. Does anybody want to tell me how that might be good debt, or if it even is good debt?
It can probably it can probably get you into getting bigger loans as well. So say if you get a car, you have a car loan, then you could probably get, like, if you're looking to get a mortgage or you're getting to get something else, then you could use that as a baseline to knowing that how you paid your loan off, or if you're still paying off on it or something like that.
Mhm.
I could be wrong, but I'm just putting it out there.
Yeah, it can certainly have its advantage, and you're correct in saying that. It can help you establish a good credit history. However, a car loan would actually be considered bad debt because, say, for example, you're purchasing a brand new vehicle. As soon as, say you purchase it for $30,000, as soon as you drive that off the lot, that car value has decreased by at least $5,000, but you owe the original $30,000 on it. So your car value is going to go down much quicker than the balance of that loan. So in that way, it's seen as bad debt. So if you can put a down payment on a car, then really you should consider doing that. What happens to a lot of people is they have a vehicle, they paid full price for a brand new vehicle, say $30,000. In 5 years, they decide they're going to, they haven't paid out the loan in full, say they took a loan for 7 years. The car value after 5 years is down to $5,000 because of the condition of it, yet they still owe $10,000 on the vehicle. But they go to the dealership and buy a brand new car again, which is another $30,000. However, they still owe on that old loan. So instead of getting a new car loan to pay for the new car of $30,000, they're building on that old loan, and they have a car loan for $40,000, but the car actually isn't even worth, not moved off the lot yet, $30,000. So you will sometimes see people who have a $70,000 car loan, and you're looking at their driveway and they have a $20,000 car. So in that way, it's definitely bad debt.
Can I say something, Myra?
Absolutely.
When I think about this, I want to also remind students, I know that we talk about credit and I know we talk about debt, but we also have to talk about that a lot of people talk about the credit limit and your credit score. Your credit score, if you really boil it down, good or bad, is based on how much money you have borrowed. So in a way, what I'm saying is you can only really build up that credit. Like if you pay your bills, your utilities, etc., right? You still get a good credit score, but you build your biggest credit score from when you borrow and then you pay back, right? Continuously.
There is so much that affects your credit score, and it really, I always kind of shake my head when people talk about credit score. Credit scores are very, very finicky, and there's so much that can affect them that if your bank or your lender is only going off of credit score and not looking at your overall credit, they are doing a disservice to you. So for example, most of you guys, you may have a credit card, and maybe that's all you have, or maybe you have a credit card and a student loan, and that's all you have. Because you don't have much of a credit history, especially those of you that are just 19, and this is your first credit card, or you've only had the credit card for a few months, or this is your first loan, is your student loan, your credit score is going to be down 500 or 600. However, myself, who even if all I have is a credit card, because I've had different loans and mortgages over time, my credit score could be in the 800s. But we have, looking at it on paper, we have the same credit. So why would our credit score be different? I have a longer history. That's all. Okay. If
Lots
you,
of questions in chat, Myra. Did you want to finish the thought or did you want me to interrupt you?
no, let's go with some questions.
All right. So Kira's asking, is there something we can pay off steadily to build credit? And do we need, and another person is asking, do we need credit to get a car loan or mortgage? So we'll do those two to start with. And
okay, perfect. So most times, yes, you need credit to get credit. So my suggestion, and what I did for my own children, as soon as they turn 19, because in Nova Scotia, 19 is the age of majority, and we can actually get you to sign up for or sign legal documents. Get a credit card in your own name. It's actually easier to get a credit card with a lower limit as a student than it is when you're out of school and have a job, believe it or not. So go to your bank, ask for a student credit card. And then my biggest suggestion is the physical card that comes, put that thing away. Set it up so that your cell phone bill comes off of it. And you need, instead of paying your cell phone bill directly to the company, you pay it to your credit card instead. So there's a charge every month, it's already in your budget, and you pay it off every month. That builds good credit. So you're using the credit card, you're paying it off in full every month, and you're not getting anywhere close to your limit, hopefully. So those are three things right there that affect your credit score. Repeated use of the credit product, not going close to your balance. So if your balance is, or sorry, your limit, not your balance. So if your limit on your credit card is, say, $2,000, and you are always at $2,000, okay? Us as lenders are going to say, wait a sec, why is it always at $2,000? Are you supplementing your lifestyle through credit? And is that why you're asking us for more credit? Do you have savings? Can you pay this off? We would be looking at all of that. But again, it could be that there was an emergency and you had to use your credit card to repair your vehicle, and now you're coming to us to get a car loan. You plan on selling your existing vehicle, that will pay off your credit card, and you're coming to us for a car loan to get a new vehicle that you can actually rely on. That makes sense. But if we're seeing a history that your credit card is always at its limit, that drops your credit score, and that gives us a bit of heartburn when we look at giving you more debt. Does that make sense? Okay, and what was the second question? Oh yes, so you need credit to get credit. So if you're going for a mortgage or a car loan in the future, if you already have credit, yes. However, it gets a little complicated with mortgages. So even if you've had bad credit in the past, and we have people who are, in their 40s, 50s, for whatever reason, they had to claim bankruptcy. Usually due to a marital breakdown or an injury. So something that is beyond their control, something that actually happens to a lot of people, unfortunately. But they're now ready to purchase a new home. What we look for is somebody who has two types of credit. So a loan and a credit card, and they've had it for at least 2 years, and the repayment has been as agreed. So for example, if you claim bankruptcy, you're discharged from the bankruptcy, and you go out, and even if you get, a Capital One secured credit card, and I'm not sure if anybody knows what a secured credit card is, but if you don't have good credit, a secured credit card is a great option. A secured credit card means that you give the company, say, $500, they give you a credit card with a limit of $500. If for any reason you don't pay that balance, they have the money already in their hand to pay it off for you. Okay, so if you're worried about your credit, or you can't get a credit card because of your past credit, a secured credit card is a really good way to start rebuilding that credit. It doesn't matter to your credit score whether your credit or your debt is secured or not. So secured or unsecured, so it doesn't matter if it's a car loan, it doesn't matter if it's a mortgage necessarily. It affects your credit score the same way. Okay, so you need to make sure that you're making your payments on time. You need to make sure that you're not using it up to its limit all the time. And you need to make sure that you have a bit of a history with it. You also want to make sure that you don't have too much credit available to you. So I see a lot of times people have 5 or 6 credit cards. There's no balance on them, but the credit score is low because they have too much credit. You're better off with 1 or 2 credit cards and a loan rather than going out and getting all these credit cards as well as the loan. So use a bit of common sense around it. The other thing that can affect your credit score, like I mentioned earlier, is just simply how long you've had credit available to you. So, but mind you, I said just being younger can have an effect on it. I do know some younger people that have had excellent credit scores. So if you do have that history of, about 2 years and you're paying it as you should, and again, the trick with putting your cell phone bill on your credit card and putting the physical card away will help you establish great credit. Your student loans do help you establish credit. When they go into repayment, make sure you're paying them, because that's where a lot of people get their credit scores lowered, is because they're not paying those student loans back as they should. The other thing that happens with your credit score, cell phone companies actually report to the credit bureau now. They're the only, I don't even want to call them a utility, but they're the only company like that. Like Nova Scotia Power doesn't report, the water company, your internet provider, they don't report to the credit bureau. However, cell phone companies do. TELUS, Rogers, Bell, if you have a cell phone, will. So we see those, and that's where most people, for whatever reason, we will always see bad repayment on cell phone bills. And that could be the one thing. They may have their student loans, they might have a mortgage, they might have a car loan, and everything's being repaid wonderfully. Everything looks good, and then their cell phone bill is like 3 months late. I don't know why, but that's the one that seems to catch people a lot. So does that make sense? Okay, and do we have other questions?
Does that include like the internet bill too? Because I know like Bell does internet and cell phones at the same time. So does that include?
Yeah, it seems to only be if you have a cell phone with them.
Okay.
And I don't know why cell phone companies report. Even some mortgages don't report to the credit bureau because it's not a law. So the way the credit reports work, there's 2 companies in Canada, TransUnion and Equifax. They are our credit bureau companies. So by law, any lender is required to report to one or the other of them. So sometimes what you'll find is you'll get approved for something at one bank because they use Equifax, which is the more common one. And another bank will say, no, you're not going to get approved because they use TransUnion and something showed up on TransUnion that wasn't reported to Equifax. So you can have those discrepancies sometimes. But both of them operate the same way. Most places report to both companies. However, for whatever reason in Canada, it is not required that we report mortgages. Most do report, but it's not required. It's not all mortgages report on your credit bureau. So even though a mortgage is a really great way to increase your credit score, and people always pay because everything's automatic usually with your mortgage, sometimes they just don't report, so they're not helping your credit score one way or another. The other thing to keep in mind is if you have a student line of credit and your parents have co-signed on that because you're under 19, that is not helping your credit score. You're under 19, you do not have a credit bureau. It doesn't start until you turn 19. Okay. The other thing is if you have, if you're getting a student line of credit and you're over 19 and your parents co-sign on it for you, because that's a requirement. If you don't make your payments, that affects your parents' credit history and credit score as well. So anybody that is signed on the agreement is affected by what you do, even though that student line of credit is technically yours. It does affect the other people that are signed on it. So if you co-sign, say, a car loan for a friend, they better be a really good friend, because they could just decide they're not paying, and then you're either on the hook or it destroys your credit too.
Excellent. Myra, a few more questions. And I should say as well, I mean, one of the slides that we're going to get into, and I can't even remember if it's today or next, we're actually going to dive into credit scores and credit ratings and what those numbers mean. So I know there's a ton of information coming out, but I just a couple of questions here in chat. Would it be considered good debt if the car is for business?
That's a tough one, because you can, for tax purposes, you can use the car as, and the loan, really, it's good debt when you consider your tax situation, if it's used for business. But it still comes down to the fact that you're paying, your loan is not going to be paid out as quickly as the value of the vehicle drops.
Exactly. And then we had somebody else say they paid off their student loan all at once last weekend, which I think is absolutely amazing, but they're wondering how that, or will it affect their credit?
It will be a good thing for your credit. Absolutely. Absolutely. The only thing I would caution about that, and it depends on, again, your own personal situation. It's paying off your student loans. If they're Nova Scotia student loans and you're from Nova Scotia and you're going to school in Nova Scotia, paying them off before you're finished your education, you can miss out on some of it being forgiven. So it's just something to, and I know it's sort of a done deal, and I'm hoping that somebody advised you around that. But it's always good to pay something out. It's always really good to pay something out. That really does work well for your credit.
And Mary's just wondering if you can get a secured credit card through any bank.
No, no, most banks don't do it. Credit unions do, and I should say this as well. I do represent CUA, but I'm not here to sell CUA to any of you guys. I'm here for the financial literacy piece. So credit unions do secured credit cards, Capital One, and I believe MBNA. I think those are the only three that, they're the only three that I'm aware of that do secured credit cards.
Thank you for answering my question. I appreciate it.
Yeah, absolutely. Okay, so we've gone over some advantages of credit, and I think we've gone over some disadvantages of credit already as well. Did anybody have any questions around disadvantages of credit? And I noticed credit cards here are definitely what they're hinting at, but that's not the only disadvantage to credit, as we've sort of gone over.
Somebody's wondering, what does it mean to secure credit?
So there's a couple of things. So if you're talking specifically of a secured credit card, you will give the company, say $500. They'll give you a credit card with a $500 limit. So if for any reason you're not able to make your payment, the credit card already has the company in advance, or sorry, the money in advance. So it's very little risk to the credit card company. They know that if for any reason you don't pay, they have your money already. Generally, they'll only hang on to that money for a year, and if everything's gone fine, they'll return that money to you and let you have an unsecured credit card. Now, if you're talking about security in general, when it's larger loans, so for example, a mortgage, because it's so much money, we want to know that if for some reason you don't pay, we have something to fall back on, okay? Because we're talking $200,000, $300,000 and up from there. So if for some reason you can't pay, then we would repossess the house and sell it to make back the money. It's not what banks want to do, not at all. I have had people drop their keys off and say, I can't do it, and walk away. It's not what we want to do. We are not in the real estate business. We're in the finance business. Okay. But we still have to.
Sorry.
Sure.
Sorry,
Yeah.
Myra, there's a lot of stuff going on in chat, which is awesome. And a lot of, I mean, I haven't read all the comments because a lot of people are just, you know, there's not a question, they're just putting stuff in there. But
Sure.
somebody's wondering, how can some of your student loan be forgiven? And I know the answer, but you should explain it to them.
I'm not sure that I know the whole answer, Brenda.
Okay.
Go ahead.
So basically, the government of Nova Scotia has come up with a program, and it's only a few years old, whereby if you're a Nova Scotia student doing a university in Nova Scotia, and you do it in the allotted time. So if you're doing a 4-year program, you complete it in 4 years, then the Nova Scotia portion of your student loan can be forgiven. So they're basically saying, here's money to go to school. Your federal portion, which is the larger portion of a typical student loan, is not forgivable. So you still have to pay that back. But let's pretend you had a $4,000 student loan. 1,000 of it may be the Nova Scotia portion. And I'm just making up numbers here, but 1,000 of it could be. And so if you graduate and complete your course in the 4 years that it was allotted, and you're from Nova Scotia and going to school in Nova Scotia, they will just forgive that. So it's a great opportunity, you know, to look at that. So, but you have to have completed your university, as Myra was saying, in order for them to go, okay, they did do it in the allotted time, so they qualify for this.
Mm-hmm. So that made me think as well, how, you know, we talked about good debt and bad debt. And I guess in a way, you know, we already talked that student loans are for your education, which then, you know, can result in a higher income, setting you up for a better financial picture in the future. So in that way, it's good debt. It's an investment, so to speak. So one thing that you can do, because what sometimes happens is that good debt sometimes turns into bad debt. So, you know, certain professions or certain situations, the student loans can become quite large and be really overwhelming. And as well, student loans, they tend to be, you know, smaller payments, so it takes that much longer to pay them out. Something that you might want to consider doing is, instead of having that turn into bad debt on you, is start putting aside into a savings account what your payment would be. Start it now. And then when you're required to pay it back, you already have a cushion there. So that if for some reason, you know, there are programs for student loans that if for some reason you can't pay, you can get another grace period, but that doesn't always get approved. You know, and you're set up and you're already used to making the payments as well. So if you get yourself used to that habit, you're building up your savings, you're prepared to pay that back. And, you know, if you don't need to use that savings that you already put aside because you just switch the payments over, then you have that money for something else, right? The big thing, and why I suggest putting your payments into a savings account until you're required to make a payment, is because student loans, government student loans, are interest-free money. So you do not get charged interest on it while you are in school. So if you can save that money now and earn a little bit on it through your savings account, do that. And I'm sure that might spur on some questions there. I don't know if I can explain that much better, but for example, my children thankfully qualified for student loans, and we have one's just finishing her undergrad this year. The other one has already finished her undergrad, but has gone on for another degree. We have the money to pay back their student loans, but because it's interest-free, we've invested that money. And just because of timing, And me knowing what I know and in the job that I'm in, the investments were really profitable. Let's put it that way. And they've made money. So even when they pay off their student loans, they're still going to have a bit of money to maybe purchase their first vehicle, or, maybe have a nice down payment, or at least a partial down payment to a home, or something like that. So there are ways to arrange even good debt and make it even better. Okay, I hope that makes sense to everybody. Okay, so we were talking about credit cards, and we'll go over this a little bit. So reading your credit card statement is actually really important, and it's going to help clarify what I was talking about with your due date and paying it off and all of that sort of thing. So the first thing you're going to find is your account number at the top. Your statement closing date, that's the date that your statement was actually printed. Okay. Your credit line, that's going to be what your limit is. And available credit is the difference between, why did I lose my mouse here? There we go. So your available credit is the difference between what your credit limit is and what you owe right now. So that's what's still available to use as of the date the statement was printed. What you're going to see here, your account summary, okay, it talks about your previous balance, any credits, any payments you've made, purchases that you've made since the statement was printed last, and of course what your new balance is. So as you can see, your purchases and other charges matches your new balance because there was no cash advances. There was no finance charge, meaning there was no interest. This person paid their previous balance off in full, and actually it looks like $20 more. So this is actually an error. Their balance should be $20 less than their purchases and other charges. Can everybody see where I'm getting that from? So
I see their account balance and their payment as being the same amount.
Well, previous balance, so
Yeah.
that would have been last month's balance.
Mm-hmm.
So this statement was printed, it looks like November 9th of 2013. So back in October 9th of 2013, the balance would have been the $1686.15.
Right.
The payments that they made right here, they actually paid $20 more, or sorry, $22 more. Or, sorry, $2 more, not
$2 more. Oh, I see.
$2 more. So if all they've charged is $523.20, then their new balance should actually be $521.20.
And I'm just going to question whether or not it is the same amount, and you and I are both seeing it as an 8 and a 6 because maybe it didn't transfer well onto the slide.
It's possible.
Yeah.
It's possible.
I know, I'm trying to look through the progressive part of my glass.
I know. It is, I mean, it looks like a 6 and an 8 to me. However, this is important. Most people get their credit card statements and just throw them out, file them, don't look at them ever. But this is why you look at them. There can be mistakes. Okay, and there can be, you think your balance should be around this. It makes sense to have that balance. So you just don't bother looking at it, but you should look at it because you never know if there's like a $2 charge that you didn't make, even a $1 charge, because if somebody gets your credit card information, they will first verify that the credit card is valid, and they will do a small charge like $1 or $2 before selling your credit card information and somebody using it. So it's always a good idea to review your statements. Even if you don't get a paper statement, review your statement once a month online. Okay, so then if we look at the payment information, the next box down here, the new balance is $523.20. And like we said, a minimum payment is going to be $10 or a little bit more based on the terms and conditions. And your payment due date is showing as, I'm going to say December 1st of 2013. Okay, So you would need to pay that $523.20 in full by December 1st to avoid any interest. If you miss that and you pay $523 flat, you did not pay that balance in full, and you will be charged interest back to the date that that purchase was made. Okay, I can't stress that enough. A lot of people miss that. Okay. Any questions about reading a statement?
Michelle just mentioned that she does her online banking regularly because her card has been fraudulently used in the past, and it causes her anxiety to wait for her statement to arrive. And I do the same thing, Michelle. I use my credit card like Myra for everything because I have a cashback card. But I'm also exceptionally frugal, which is a great word for cheap, and I hate to pay interest. So every Friday morning, I log into my bank and I pay my, I'm lucky because my budget is very small as well because I'm very frugal. And so I'm able to go in every day or every Friday and I pay my balance off in full every Friday morning. Because if I left it for a month, that would be a lot of money because I put everything on my card. But I find if I go in every Friday, it's more manageable for me to be able to pay it in full. Occasionally, I have to wait for another paycheck to come in to make that final, to get it paid off. But I'm the same way. I check it every week and I check my credit score regularly as well.
And if you get into that habit, checking it once a week, making that payment of the balance once a week, that can really help keep you on track. The more frequent you're paying off your credit, the less interest you're going to pay in the long run, whether it's a credit card, a loan, or a mortgage. The more frequent your payments, the less interest you will pay. Okay. Any other questions about reading your statement? Okay. So different types of debt. So we talked a lot about this. Did anybody have specific questions about the different types of debt? So your credit cards, lines of credit, loans, and mortgages? No?
Somebody just says lines of
explain lines
credit.
of
So
credit,
it might be a
please?
little bit, oh, sorry, somebody go ahead. Somebody was speaking.
Can you just go over lines of credit just one more time, please?
Sure. So we'll sort of categorize these types of debt into two different categories. A credit card and a line of credit is what they call revolving credit, and loans and mortgages is non-revolving. So, as you know, a credit card or a line of credit, say you have a limit of $5,000. You can use that $5,000 and then pay $2,000, but you still have up to the $5,000 to be able to use. So in that way, it's revolving. You always have the limit of $5,000 to use, minus whatever your owing balance is under that. So a credit card, line of credit is revolving credit, okay? They require payments, by the due dates. Generally, it's once a month. Simple interest is charged on those. And, generally with a credit card, the interest rate is fixed. With a line of credit, it's usually a variable interest rate based off of prime. Your line of credit, your payments can be your minimum payment can be a certain percentage of the outstanding balance, or it can be a fixed payment. So usually your fixed payment will be based off of what your total limit is, broken down into payments once a month over the year. So there are different ways that you can set up a line of credit. Credit card is going to be minimum payment, a percentage, $10 or a percentage of your outstanding balance. However, like we've discussed, credit cards, it's always a great idea to pay it off in full as soon as you can, but definitely by the due date. Loans and mortgages are non-revolving because as you make payments on those, that just goes away. You don't get to draw on that money again. It just goes away. So you pay it down and you don't get to use it again. So for example, your student loans, they give you the money, and when you're paying it down, you're just paying it off. It's as simple as that. With a student line of credit, you can use $5,000 this year. You work really hard over the summer and say you're able to pay that $5,000 back. School starts in September, you can draw that $5,000 back down again. When I say draw down, I mean use it, okay? Does that make sense, the difference between revolving and a non-revolving?
Yes, thank you.
Okay, perfect. Any other questions on those?
I'm just going to throw in there a little bit too. A lot of times you can actually get a line of credit card, which is a little bit even more confusing. But a line of credit tends to be a lower interest rate. And as Myra had said before, they're usually tied to the prime rate of Canada. So it tends to be a lower amount, but there's, I think, usually a bit of a charge for that card, isn't it?
It depends. It depends on what bank and what program there's just so many products that are very, very similar, but there's always little differences. That's why you need to review your terms and conditions with your lender. Okay, because you can think that you're getting a particular product because that's what you heard about, that's what you saw on the website, and what you really end up with is something a little bit different, and the lender gave you that because it actually suits your situation a little bit better, but they weren't great at explaining to you what the difference actually was, and it could end up being detrimental to you if you don't understand the full terms and conditions. So a line of credit card, it gives you the convenience of making purchases like a credit card, but it draws off your line of credit. Again, the biggest benefit to that is the lower interest rate. So people will use those generally for home renovations. So you don't a loan for a home renovation, they would dump the money in your account and you would have to make payments and pay interest on that. But it's possible that you only use a couple $100 this month and the big bulk of the money that you need isn't for another 4 months, but you're still paying on it, you're still paying interest on it. The advantage of a line of credit or a line of credit Visa, you only pay interest or payments on what you have outstanding for a balance at the time. So you can save a little bit of money that way too. I know that can be really confusing. Okay, so we've talked about the different types of debt. Does, and again, any questions outstanding, anything any experiences that you've had that you're wondering about that we haven't answered yet? Okay, great. I do want to also mention, and I say this with most of my sessions, so if you're coming to all of the sessions, you will hear it again and again, but it's worth saying and it's worth repeating. Build a relationship with your bank. Doesn't matter what bank it is, build a relationship with your bank. Interview your lender. They now call them financial advisors because they don't just talk about lending. They will talk to you about investments and savings and all of that. Build a relationship with somebody and interview them because you need to know that they understand what your goals are financially. And, they also need to understand how you communicate. So I have had clients who can be all over the place, but if I paid attention, there was that common thread down through it and I could bring them back into that. And then there would be people who come in, it's like, this is what I want. And it's like, hold on, I'm not an application filler. What do you need it for? What's the whole story? And if somebody's not willing to sit down and talk to you or explain things, if they're not going to take the time or communicate with you effectively, if you don't feel that they understand your goals, move on to the next person. It's very much like finding a doctor. You need to know that you can trust this person because they're your expert. And you need to know that this person has the knowledge, and if they don't necessarily have the knowledge, they know who to send you to. You know, I stress all the time, interview your financial advisor. You don't have to stick with the same bank. You can sit down and talk to somebody. If you're like, you're just not getting me, get up and go to the next office, right? This is important. This is your financial health. They're a tool in your financial health overall. And you need to know that you can trust them. You know, it's the same thing as your car. Is your car reliable? Is your car, you know, going to start each and every time you need it? If there's an emergency, will your car start? You know, it's the same thing here. If there's a financial emergency, are you going to be able to get a hold of that person? Are they going to take the time to understand? Are they going to say, you know, don't worry, we talked about potential emergencies already. This is what we discussed, right? You know, are they looking at your picture, not just a general picture? The other thing to keep in mind, and I say this in all of my sessions too, if you are looking for an opinion, ask your friends. If you are looking for advice, ask the experts. So if you want financial advice, go to your bank. Like I mentioned earlier, what works for your friend, what works for your sibling, what works for your parents may not work for you, because it is a very personal picture. Okay. Any
Couple more
questions?
questions in the chat.
Good.
Somebody's asking if you can be denied a student loan.
Yes. Yeah, there's qualifying criteria. Absolutely. With any type of debt, there is qualifying criteria. So a student loan, and this is different. So student loans are very different from going to your bank and asking for a loan, line of credit, whatever. A student loan is based on need. So you need to prove your need for the financing or for that money. If you go to a bank, you need to prove your ability to repay. You don't need to, and you'll hear that sometimes. People will say, oh yeah, the bank will only lend to you if you don't need the money. That's kind of how it is. We need to know that you can repay it. So if you go to your bank and you're like, well, I lost my job and I want to buy this car. Well, no, you can't repay that loan. We're not going to give it to you, right? Like it just, but a student loan, I'm going to school, I'm not going to be working. You know, my parents are lower income, or, you know, in my case, a single parent. That's what qualifies you for a student loan. It is need. Okay, does that make sense?
And then somebody's wondering, to get a line of credit, you need employment, right?
Depending on the type of line of credit. So a student line of credit, you don't, but your parents do. Or your co-signer, I shouldn't say your parents, it could be a grandparent or an aunt or uncle, or even a sibling that co-signs for you. But in general, a line of credit, yes. A line of credit, credit cards through the banks, if you're not going to secure it, then yes, you need to have income to show that you can pay it. That comes with a qualification as well. So in Canada, our banking regulators hold us to a certain standard. When it comes to your income, we can only allow you to borrow up to 40% of that income for your debts and certain necessities like housing and heat. Okay. So for example, a lot of people come to us, they want to get a mortgage, and they think, oh, I want this house, it's $500,000. I make $60,000 a year. And we're like, okay, don't think you're going to be able to afford $500,000 mortgage. We hit good. So, you know, we also have to consider your other debts. So this person comes to us, they want $500,000 for a home. They already have a car that's $50,000. They pay, say, for example, support of $700. Well, you know, it's going to be kind of tight to get that mortgage. And even if you can pay rent of so much, that doesn't matter to us. Rent is not based on what you can afford. Rent is based on, you know, do you have a decent credit history, right? They don't care about what you make. If you have a decent credit history, you can get that apartment. With us, you want that mortgage, you have to show us that you can afford it. Okay, and we can't go over 40%, because if we go over 40%, that does not leave you room for things like groceries, other utilities other than heating, your property taxes, your insurances, childcare, for example. It doesn't leave you enough money to live, basically. And the other reason that we do that is because when we do take your income, you tell us you have an income of $60,000. Well, you don't get $60,000 in your pocket. There are taxes that are taken first. So that's why we can only go up to 40%.
And Tony's wondering, if they say a little bit off topic, but I don't think it is at all. Can you have more than one mortgage?
Absolutely. Absolutely. If you can afford it. Yep. You can actually have different types of mortgage products on the same property, provided that you don't go over 80% of the value of the property. So for example, I have, you often hear about total equity plans. So I can borrow up to 80% of the value of my property, and I can have it broken down into, so say for example, my property is worth $100,000. That gives me a limit of the equity of 80,000. I could have a $20,000 mortgage, which leaves me 40,000, or sorry, 60,000 that I could borrow up to. I could have another 30,000 in another mortgage on the same property. And that still leaves me with, 30,000 to work with. Total equity plans are really nice ideas, but again, if you're not good with revolving debt or paying things down, it might not be the right decision for you. So again, you need to have a financial advisor that knows what your habits are and can advise you correctly. Or, if you have income property, you can have a mortgage on each property. There's all sorts of reasons why people have multiple mortgages.
And Tony's also wondering if we'll talk about equity at all during the sessions. And I believe we do talk about equity a bit during the sessions, but it's not a big piece of our topics, but we do talk a little bit about it. And then Carrie Lynn said that, or asked, or said, I grew up hearing that housing should not be more than 30% of your income, but you just mentioned 40%.
So there's two things that need to be considered. There's your total debt service ratio, which should not go above 40%. We do occasionally go over the 40% in certain circumstances. So your total debt service ratio, like I was saying before, includes everything like your housing, your heating, other debt repayment, support payments, all of that sort of thing. And then there's the other side of it, which is your gross debt service ratio. And that is only your housing, which includes your property taxes and your heating. So you are correct. And actually it's 35% generally that we don't go over. So, and that's, you've probably heard the term house poor. If you go up to 40% on your gross debt service ratio, so that's only your mortgage, your heating, and your taxes, that makes you house poor. You can't get any other lending. You have your house and that's it. Okay, so that's the idea behind that term. So
Laura was wondering if we can share the slides, and what we will be sharing, Laurel, afterwards, and everybody, is we are recording it, and I won't have the recording till later today because it has to do its thing in the background, but then I'll send it off to Natalie. If we want the slides, we could send the slides as well, but the slides are counted and everything. And I am watching the time, Myra. We're up to 11 o'clock already, so.
We are. So, I can certainly wrap it up here. However, sorry, I have somebody trying to call me because it's 11. So we can certainly wrap it up here. I'm just going to go quickly through Yeah, we talked a little bit about the government student loans, secured loans, a little bit about mortgages, revolving credit and non-revolving. We didn't get into amortization as of yet, and that's just the length of time that it takes for you to pay something off. So we basically hit all of the information. I want to thank you guys for being really interactive. That's fantastic. And I was going to, let me see, I'll put my email address up here. Here we go. So there, you have my email address there as well. If you have any questions that, if you want a little bit more privacy around asking those particular questions, but certainly reach out. This is what we're here for. Again, I want to thank you guys for your participation today. It was very interactive, and that is great. I hope everybody gained something from this, and I hope to see all of you next week as well.
Thank you very much for your
Thank you.
time.
Thank you very much, Myra. We'll see you next week.
All right,
Thank you to everyone. Thank you for being here. I'm so excited to have so many people here, and Myra always has so much great information. So thank you, Myra. Thank you, Natalie. And thank you to everybody for joining us. I'm going to stop recording.
Students, if you know another student that would benefit from this program, please send them the invitation. We'd be happy to have them. Students of Mount St. Vincent University.